Hi, my name is Yoshida Sensei, and today we're breaking down one of the most important concepts in investing: stocks versus bonds. What they are, how they work, which one is safer, which one makes you more money, and how professionals actually use both together to grow with wealth without losing sleep. Whether you're just starting out or you're trying to make smarter decisions with your savings, understanding stocks and bonds is essential. Starting with bonds. When you buy a bond, you are lending money to a government or a corporation. In return, they agree to pay you a fixed interest called a coupon at regular intervals, and return your original amount called the principal or face value at a specified date in the future known as maturity. For example, imagine you buy a 10-year US Treasury bond for $1,000 at a 4% interest rate. That means you'll receive $40 per year for 10 years, and at the end, you get your $1,000 back. But here's where it gets interesting. You don't have to hold your bond until maturity. You can actually sell it in the secondary market, and the price you will get depends upon several factors. Most importantly, interest rates. If new bonds are being issued at higher rates, say 6%, your 4% bond becomes less attractive and its price falls. On the other hand, if rates fall to 2%, your bond looks great and its price can rise. Bonds are considered relatively safe, especially government bonds. That's because defaults, which means when the owner can't pay you back, are extremely rare with major governments. A country like the US has never defaulted on its debt, but corporate bonds, especially lower rated ones, carry more risk. They can pay higher coupons, but the risk of default is also higher. Stocks are a different game entirely. When you buy a stock, you're buying a piece of a company. You become a shareholder, an owner. Your return as a shareholder comes in two ways. The first being price. Price appreciation is when the company grows and becomes more valuable. Its stock price rises. Dividends are a portion of the company's profit paid out to its shareholders, though not all companies may pay them. But with that ownership comes more risk. If the company underperforms or goes bankrupt, you're at the bottom of the ladder. Bondholders get paid first, stockholders often get nothing. However, the potential upside is far greater. Let's say you invested in Amazon or Apple in the early 2000s. Your return wouldn't just beat bonds, they'd multiply your investments many times over. That's because companies can scale, innovate, and tap into massive markets. Stock prices reflect expectations for future profits, and when companies exceed those expectations, prices can surge. But the volatility is real. A company can drop 20 to 30% in a single quarter if earnings disappoint. Stocks essentially reward growth, but they do punish uncertainty. So, how do they compare? Bonds offer stability and income. They're less volatile and have a predictable cash flow. Stocks, on the other hand, offer growth. They carry higher risk but also the potential for far greater returns. In the long run, US stocks have historically returned about 8 to 10% per year, while government bonds have returned 2 to 5%. But remember, higher return comes with higher risk. That's why a key principle in finance is diversification, which means not putting all your eggs in one basket. Investment managers don't just pick between stocks and bonds, they blend them carefully to build portfolios that are tailored to risk tolerance, goals, and market conditions. The idea is this: bonds offer stability but relatively low return. Stocks offer growth, but they can swing wildly. A mix of both allows managers to lower overall risks while still aiming for better returns than bonds alone. For example, a 25-year-old investor with a long time horizon might have a portfolio that's 80% stocks, 20% bonds. A retiree might reverse that: 30% stocks and 70% bonds, in order to preserve capital and generate income. Even large institutions like pension funds and university endowments use a combination. They need steady income from bonds to meet obligations, but also long term growth from stocks to outpace inflation and grow the fund. Let's be clear: no professional money manager invests entirely in bonds, and very few keep 100% in stocks. The blend is what matters, and that blend is adjusted over time, depending on the investor's goals, market conditions, and appetite for risk. So here's what we learned: bonds are predictable, They give you income, they're slow and steady. Stocks are ambitious, they offer growth, but they can test your patience. Investing isn't about choosing one over the other, it's about building a portfolio that works for your goals, your timeline, and your nerves. That's why professionals blend both to lower risk, aim for higher returns, and stay invested for the long run. If you found this video helpful, please like, share it with someone who is just getting started, and subscribe to the channel. I'm Yoshida Sensei, and class is officially dismissed.